Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today we're diving into Fiserv, FISV.
And this is a big one. When a company that the market treats like a utility, something foundational to our entire payments ecosystem, creators like this one did, it sends shockwaves everywhere.
It really does. The market has priced in an absolute catastrophe, wiping out billions in value. So our mission today is to get under the hood of that shock.
Right. Is this a temporary self-inflicted wound that a new team can fix? Or has the foundation suffered a fatal collapse? The company in question, Fiserv, ticker FISV, is really a textbook case.
Okay, let's unpack this. Here is the central conflict we are digging into today. Fiserv is leveraging its massive $6.7 billion operating cash flow and integrated financial infrastructure to execute a necessary strategic reset.
And they're trying to position the company for a recovery, a potential one, to double-digit EPS growth by 2027. All this despite a punishing 44% stock collapse and the exposure of a deeply misleading growth story.
So the core question is the market overreacting to the short-term pain, or is it correctly seeing a long-term failure?
That's the entire thesis right there.
To really get the scale of this crisis, you first have to grasp how huge and complex this business actually is. Fiserv is it's fundamentally a company with two cores. It lives in two separate but increasingly connected worlds.
That's a good way to put it. On one side, you've got the part everyone sees, the high-growth, tech-driven side, merchant solutions.
Right.
This is the business that deals directly with small and medium-sized businesses all over the world, and it's all driven by their flagship product, Clover.
And Clover is so much more than just a little terminal on the counter, right?
Yeah.
It's designed to be a complete operating system for a merchant.
It's the nerve center. It handles transactions, of course, but it also does inventory management, customer loyalty programs, analytics, reporting. It even provides access to capital through Clover Capital. It's a whole ecosystem.
Which is exactly why competitors like Square and Toast are fighting so hard for that same space. They want to own that merchant relationship.
And this ecosystem is just vast. The data shows Clover is now serving over 1 million users globally. They've also invested a ton in hardware for different needs.
Like the Clover Flex, the mobile one.
Exactly. The Clover Flex for, say, a restaurant taking payments at the table. And then you have the Clover Mini, which is that compact countertop one you see in a lot of retail shops.
So the revenue isn't just from transactions. It's also hardware sales and, more importantly, those recurring subscription fees for the value-added services.
That's the high-margin stuff, yes. But then you have the other heart of the business, the quieter, more foundational core, financial solutions.
This is the plumbing, as you called it before we started. The mission-critical, high-switching cost utility that really sets Fiserv apart from just a pure digital payments company.
It is the foundation of the American banking system. I mean, they provide the core banking platforms, the card issuing platforms like Optus, all the digital banking tools that financial institutions need to run.
And we're not talking about a small number of clients.
No, not at all. We are talking about critical infrastructure for about 3,500 banks and credit unions across the U.S. alone. These are long-term contracts, years long, that provide this super predictable, sticky, recurring revenue. That's the ballast for the whole company.
Okay, so a company with that much structural stability, that kind of ballast, sees its stock drop 44%.
A 44% drop.
That's a $30 billion market cap loss on a single day, October 29th, 2025. That doesn't signal a bad quarter. That signals a catastrophic failure. What was the exact trigger?
The trigger was an immediate, and I mean severe, cut to their full-year organic growth guidance.
What were they guiding to before?
They had been consistently promising and reinforcing this robust range of 10 to 12% growth. That was the story.
And they cut it too.
Overnight, they slashed it, all the way down to a shocking, meager 3.5 to 4%.
Wow.
For the financial markets, that's like a high-speed train hitting a brick wall. It's a complete stop.
And it wasn't just about missing a number. It vaporized the entire perception of the company. For years, Fiserv had sold itself as this double-digit growth tech leader.
It did. And this guidance cut basically forced them to admit that if you strip away some, let's say, creative accounting factors, the core business was really just a mid-single-digit grower.
Yeah.
Solid, but not exciting.
Not a tech darling.
Not at all. And the management review that followed exposed two critical and deeply concerning factors that had been artificially inflating those prior growth numbers. So the market wasn't just reacting to a bad quarter. It was reacting to the exposure of a completely flawed narrative.
Okay, let's get into the weeds on that, the root causes. Let's start with the first flaw, what you called the sugar rush from Argentina.
Yes, this was a cyclical, hyperinflationary revenue stream that was essentially camouflaging stagnation in other parts of the business.
How did that mechanism, the anticipation revenue, how did that actually work?
It's a fascinating thing that really only happens in hyperinflationary economies, like Argentina was experiencing. So in a stable economy, a merchant swipes a card and gets their money pretty quickly.
A day or two later.
Right. In Argentina, with extreme volatility, there are long settlement dates.
Yeah.
And during that time, the value of the money is just plummeting.
So if you're a merchant and you have to wait 60 days to get paid, your money might be worth 10% less by the time you get it.
Precisely. You can't run a business like that.
Mm-hmm.
So Fiserv stepped in. They offered this anticipation revenue. They'd front the cash to the merchant immediately.
So it's like a high-interest, short-term loan.
Exactly. A form of financing. And the income Fiserv made from the interest rate spread was massive because it was pegged to Argentina's hyperinflationary rates.
And the scale of this was just staggering. It feels like the collapse was inevitable as soon as those rates changed.
It was. We are talking about a single, highly volatile revenue source contributing a massive 10 percentage points of the company's 16% total organic growth in the prior year.
10 points out of 16. From one product in one country.
Yes. So when the government there started to get its budget under control and those structural rates moved down, that huge interest rate-fueled growth it evaporated. Instantly.
And how much did it drop by?
Management said the contribution from that source fell from 10 percentage points of growth down to just 2 this year. It just vanished. Now, they argue nothing is fundamentally broken. The transactions are still happening.
But the growth metric was distorted. They used this hypercyclical revenue to paint a picture of repeatable global organic growth. That feels like a failure of transparency at best.
I'd agree. It really calls into question the priorities of the previous management team. But, the second flaw was arguably even more damaging.
How damaging?
Because it pointed to internal dysfunction and, frankly, client abuse. This was the Clover forced migrations and the churn that followed.
Okay, so the strategy was to get everyone onto their flagship Clover platform.
Right. And they decided to do that by forcing clients off their older legacy Payzy gateway platform.
And this wasn't an invitation. This was a mandate.
It was a mandate. And management later had to admit that this was done primarily for their own internal operational efficiency to save money on maintaining the old system.
Wait a minute. So you're forcing existing, presumably happy customers onto a new, more complex and often more expensive product just to save your company some money on the back end.
That's a perfect summary. They prioritized their own balance sheet over their client satisfaction. And it was a fatal error.
I can't imagine those merchants were happy about it.
They were furious. A lot of these were smaller, simpler businesses. They were suddenly forced to buy new Clover hardware, subscribe to functions they didn't need. It just added cost and complexity.
So they churned.
They churned in huge numbers. They felt betrayed. They felt nickel and dimed, and they fled to leaner, cheaper competitors.
So Fiserv gets a short-term bump in their Clover new customer numbers, but they've just created a pool of angry ex-customers who are now actively promoting their rivals.
Precisely. And the numbers confirmed it was a catastrophe. When Fiserv reported for Q1 2025, Clover's gross payment volume growth, or GPV, had dropped to just 8%.
8%? And what had it been before?
They'd been touting robust 14 to 17% growth throughout 2024. This was a steep, undeniable deceleration.
The analysts must have smelled blood immediately.
Oh, they did. JP Morgan's analysts pointed out they were seeing, and this is a quote, the widest spread between revenue and volume in our model's history, raising concerns about sustainability.
That's key language. The quality of the revenue is suspect.
It was, and Bernstein confirmed it, highlighting very significant churn from these forced conversions. So in plain English, the growth was a mirage. They were just moving clients from one internal bucket to another and then losing them out the back door. This is the structural dishonesty that led directly to the legal crisis.
So you have this perfect storm. The Argentina sugar rush collapses, and this massive internal execution failure is exposed all at once. The company is at a true inflection point.
A crisis. And it demanded an immediate radical house cleaning, a full leadership overhaul to fix this deep operational and trust deficit.
And the change was pretty swift.
It was sweeping. The new CEO, Mike Lyons, who'd only been in the job since May 2025, acted very decisively. He brought in a new C-suite focused on accountability.
Including a new CFO.
Yes, the crucial appointment of Paul Todd as CFO in October. Todd is an external hire, and importantly, he comes with deep experience from competitors like Global Payments and TSYS. Bringing in someone who knows your rival's playbook inside and out, that signals you're serious.
And the talent injection didn't stop with the CFO. They brought in 2 co-presidents.
An amazing assemblage of talent, really. You have Takis Georgakopoulos, who was the global head of payments at JP Morgan, and even more surprisingly, Divya Suryadevara, the former CFO of both Stripe and General Motors.
That's a powerhouse team. So they came in and introduced their comprehensive response, which they called the One Fiserv strategy.
Right.
Now, with all due respect, One Fiserv sounds a bit like classic consultant jargon. How do we know this isn't just a glossy rebranding of the same old problems?
That is the essential skeptical question. And the proof is in the execution, of course. But the details of the plan suggest there's some real substance behind the slogan.
What are the pillars of the plan?
It focuses on 5 concrete pillars. And it's all about pivoting the culture away from those short-term games like the Argentina yield or the forced migrations and towards sustainable client-focused growth.
And part of that is addressing the sins of the past, specifically the underinvestment.
Yes, they flat out admitted that previous management deferred necessary investments and that hurt the client experience. So the new team is putting its money where its mouth is.
With a huge CapEx increase.
A massive ramp-up. Capital expenditure is immediately going up to $1.8 billion for the year. That's a $300 million increase over the prior plan. And it's very targeted.
Okay, let's break that down. Where is that $1.8 billion actually going? Because that's where the real execution risk is.
A big chunk is going right into what they call operational resiliency. That's the defensive spending, strengthening data centers, improving uptime, basic processing speed, their utility. They can't have outages.
And the other part is more offensive.
Right. Product modernization, a big focus on integrating AI. They've even launched Project Elevate with IBM to embed AI across the business, from sales and onboarding to fraud detection. It's about building a whole new tech foundation because they know the old one was lagging.
So they're fixing the plumbing and installing smart appliances, so to speak. But fixing the tech doesn't help if the culture is still about squeezing partners. I know they're also reversing some of those junk fees.
This is a huge trust-building exercise. The old management had put in all these little fees that gave them a quick revenue bump, but just infuriated their distribution partners, the ISOs, and their partner banks.
Can you give an example of a fee they got rid of?
Sure. They reversed the end-of-life fees on Clover hardware, so they're no longer charging clients when their equipment gets old. And they adjusted pricing on the Star and Excel debit networks. These fees were small, but they signaled a profound lack of respect. By killing them, they're trying to turn their partners into, as they say, net promoters.
Okay, so that's fixing the past and the present. But what about future growth? Let's talk about the really forward-looking stuff, the stablecoins.
This is probably the most aggressive and, exciting part of the One Fiserv plan. New management sees that the future is 2047 real-time settlement, and Fiserv sits at this perfect nexus, connecting merchants and banks.
So they can use stablecoins to facilitate that.
Exactly. They can integrate stablecoins to enable instant, around-the-clock settlement within their own ecosystem. This is a huge leap. It allows them to become the liquidity provider for their own system.
Turning them from just a transaction processor into something more like a full-stack digital bank for their clients.
Precisely. They eliminate legacy banking hours and settlement delays, and they're moving fast. They're launching FIUSD, which is their own white-label stablecoin.
And they have a pilot program, right?
Real-world pilot, yes. A partnership with the Bank of North Dakota for the Roughrider Coin project, which is focused on agricultural payments. This isn't just a white paper, it's actual implementation.
And to power all this, they're buying Stonecastle Cash Management.
Which is not just another tech buy. It's essential infrastructure for this vision. Stonecastle enhances their digital currency custody and liquidity networks, so they can manage all this digital cash flowing through the system. It's vertical integration into the future of money.
Okay, let's pivot to the cold, hard numbers and this financial dislocation the market created. The turnaround story is great, but the performance before the crash was slowing down.
The metrics were flashing red, absolutely. The underlying gross payment volume, or GPV, growth decelerated sharply. It went from a robust, say, 17% in Q2 2024 all the way down to just 8% in Q1 of 25. The engine was sputtering.
And yet, even with the stock collapsing and this narrative of failure, Fiserv is still a critical financial utility. It is an absolute cash engine.
It is. This is why the idea of a fundamental collapse is probably flawed. The scale ensures they survive. In the first 9 months of 2025, the company still generated $4.12 billion in net cash from operations.
So the structural assets are fine. It's the management that needed fixing.
Exactly. The assets are intact. Which brings us to the valuation mismatch. If the core utility is stable, why is the stock trading at a disaster price?
It's a crisis of confidence.
Amplified by the legal problems, which we'll get to. The stock is now trading at what you have to call distressed multiples, a forward PE of roughly 9 times, and a price to free cash flow in the 7 to 8 times range. The market is pricing in a severe continued degradation.
It's assuming the worst.
It's assuming the CapEx will be wasted and competitors will eat their lunch.
But the bull case here, the counter thesis, relies on that structural floor. What's anchoring the revenue base?
The sheer volume. We're talking about a floor provided by an estimated $337 billion in annualized Clover GPV. That volume is so massive and durable, it provides this incredibly stable, recurring revenue stream.
And that's before the value-added services.
Right, and the integration with 1,000 banks creates a huge moat. Even if growth slows, that volume isn't going anywhere fast.
Okay, beyond the merchant side, there's also a massive overhaul happening in financial solutions, the core modernization.
This is a mammoth undertaking. High risk, very complex. They're trying to streamline their legacy core banking systems. They're going from, get this, 16 different cores down to just 5.
16 down to 5. That sounds like open heart surgery on the utility business. What are the key new platforms?
The 2 big ones are FINSACT, which is their cloud-native open API core, and the new Core Advanced platform. The whole idea is to reduce maintenance costs, increase speed, and let banks plug in new services much more easily.
The market must be worried about another forced conversion disaster, though. Alienating 3,500 banks would be terminal.
A huge concern. But this is where they've shown they learned a direct lesson from the PayZ failure. Management has publicly committed to no forced conversion timelines for their bank clients.
So they're selling it as an upgrade, not a mandate.
An upgrade. They're selling the benefits. They even told clients at their forum that if Fiserv misses a conversion timeline, the client benefits financially. That's a huge commitment. It shows they know trust has to drive this.
Okay. So as the company is focused on this incredibly complex internal reset, it's facing these massive external headwinds. Let's start with the biggest one. The shadow of legal liability.
The legal risk is very serious and very immediate. They're facing a Securities Class Action lawsuit in the Southern District of New York. And this isn't a minor slap on the wrist.
It alleges that executives, including the former and current CEOs, misled investors.
It does, over a period from mid-2024 to mid-2025. And the core allegation is that they knowingly and falsely represented Clover's rapid growth as coming from sustainable new client acquisitions.
When in reality, the lawsuit claims they knew it was just these unsustainable, churn-prone, forced migrations from PayZ.
Exactly. So when those migrated clients fled to competitors, the true anemic organic growth rate was exposed and the stock crashed. The lawsuit is a massive reputational risk hanging over this entire turnaround.
And that legal shadow makes the execution risk for 2026 even greater. Management has deliberately told everyone to expect a painful year.
It's a bold move, really. They've designated 2026 as a transition year. They're forecasting low single-digit organic revenue growth and modestly down adjusted EPS for the whole year.
They're telling the market, we're slowing down on purpose to rebuild the foundation.
Right. This is the necessary cost. They have to absorb the expenses of that $1.8 billion in CapEx, reverse the old tactics, and get the culture right. They expect margins to trough out in the first half of the year.
So if they're deliberately slowing down, spending billions, and focused internally, that creates a huge window of vulnerability for their competitors.
A huge window.
And the reset is basically an admission that competitors like FIS and Jack Henry on the banking side, and especially Block and Toast on the merchant side, are gaining ground.
And they're gaining ground because of Fiserv's past mistakes.
Exactly. Dissatisfaction with service lapses, anger over the forced migrations. These competitors are winning those churned Clover customers.
So the risk is that a prolonged execution drag in 2026 allows these rivals to permanently erode the core business while Fiserv is busy looking inward.
That's the risk. Client trust, once it's gone, is incredibly hard to win back, especially when there's a class action lawsuit providing the narrative for your competition.
So what does this all mean? We have this high-stakes, multi-billion-dollar turnaround that hinges entirely on execution. The market has priced in failure, which suggests the reward could be substantial if this new management team can actually pull it off.
The turnaround case is compelling, but it relies on two big things. First, the people. The new management team, Lyons, Todd, Sridhara, is seen as a radical upgrade in operational discipline. It signals a real cultural shift.
And second, the technology. The pivot has to work.
Success means they have to flawlessly deploy that $1.8 billion in CapEx. They have to fix the resiliency issues. They have to Commerce Hub, their enterprise gateway, fully built out by early 2027, and they have to nail the stablecoin integration.
And if they do all that,
they emerge in 2027 as what the street would call a true constant compounder.
a resilient, high-quality business that can actually deliver that promised double-digit EPS growth, supported by real operational leverage and a new client-first culture.
Right. And the big lingering doubt, is whether that deep legal liability from the lawsuit will cause insurmountable reputational damage. And will that one-year transition drag in 2026 cause too many clients to leave for good? This is the inflection point. Short-term pain for potential long-term gain.
A fascinating test of financial gravity and executive mettle. The stakes could not be higher for this critical piece of our financial infrastructure. Thank you for joining us on this deep dive into the Fiserv Strategic Reset. Host and expert, risk defined, portfolio protected.